Chinese leader Xi Jinping rings in the new year with a rare admission that China's economy is in trouble. In his televised New Year speech, Xi said, "Some Chinese enterprises are struggling and some people have difficulty finding jobs and meeting basic needs." This is the first time Xi mentioned the economic challenges in his annual New Year's messages since he started giving them in 2013.
Regulatory measures, Tesla's impact, and international relations. NIO is currently facing a challenging landscape amidst China's economic challenges. As a prominent Chinese electric vehicle maker, NIO has been navigating through turbulent times in the country's stock market, with recent data showing a decline of nearly 44% in December vehicle deliveries compared to the previous month. Despite these setbacks, NIO remains the key player in the Chinese EV market. But how will they weather the storm and emerge stronger?
But the market has been absolutely hammered. Whatever kind of stimulus or talk of stimulus or jawboning that was done earlier last week fizzled out by Friday, and there was chaotic trading. The CSI 300 was down 3.4%. So we've seen monthly losses now for 6 months in a row. $6 trillion worth of market capitalization wiped out. People are getting quite skittish if they haven't already been over the last 6 months, obviously. Now, the CSRC, the securities regulator, out with a statement yesterday, not surprising given the rout on Friday.
First, let me fill you in on China's latest move in its financial sector. China has appointed Wu Qing, a seasoned capital markets veteran, to lead the nation's securities watchdog. This decision comes amid efforts to stabilize the country's $8 trillion stock market, which has been facing a downturn. Wu, who previously served as the head of the Shanghai Stock Exchange, brings a wealth of experience to his new role as chairman and party chief of the China Securities Regulatory Commission. Before his promotion, Wu played key roles in Shanghai's financial center and the CSRC, focusing on fund supervision and risk management for securities firms. His appointment follows a series of measures by Beijing to shore up investor confidence, including restrictions on short selling and increased state intervention in the market. As China aims to strengthen its financial system and support economic recovery, Wu faces the immediate challenge of restoring trust among its many individual investors who have seen significant losses in recent years. China's stock market has experienced a sharp decline in market capitalization over the past 3 years, exacerbated by the challenges posed by the COVID-19 pandemic. While his immediate focus will be on short-term measures to boost investor sentiment, Wu is also tasked with addressing long-term reforms to address systemic issues in China's stock market. During his tenure at the Shanghai Stock Exchange, Wu earned a reputation for his tough stance on market oversight and his efforts to curb excessive speculation. Under his leadership, the exchange implemented measures to monitor trading activities and crack down on market manipulation. So, what more is China doing to stabilize its turbulent stock market? Here's a breakdown of the key policy moves and measures taken recently. They've replaced the head of the China Securities Regulatory Commission with Wu Qing, showing a shift in leadership. They're also suspending brokerages from borrowing shares for lending and capping securities relending to curb short selling. Furthermore, they're increasing investment in Chinese stock exchange-traded funds by state fund Central Huijin Investment to boost market stability. Additionally, they're tightening scrutiny of margin financing and malicious short selling while guiding brokerages to provide investors more time to answer margin calls. They've also restricted cross-border swap transactions by Chinese brokerages to limit speculative activities. These steps demonstrate China's commitment to restoring confidence in its stock market, which has declined significantly. Now, that's just the tip of the iceberg for Chinese electric vehicle makers, especially NIO. Shares of major Chinese EV companies took a hit following weaker than expected fourth-quarter earnings from Tesla, raising concerns about a global demand slowdown. Tesla's CEO Elon Musk's warning about potential competition from Chinese EV makers without trade barriers also fueled worries about future export restrictions. Hong Kong shares of leading Chinese EV companies like NIO Inc., Li Auto, and Xpeng plummeted between 5% and 8%, while BYD, a significant competitor of Tesla, saw a 3.5% drop. Even contemporary Amperex Technology Co., a key battery supplier for Tesla, suffered a 1.4% decline in Shenzhen trade. This decline mirrored Tesla's 3% fall in aftermarket trade, driven by weaker than expected earnings and a cautious outlook for 2024. As the company anticipates notably lower sales growth amid increased regulatory scrutiny in China and global market saturation.
Take the electric vehicle sector. It is a crucial industry for the clean economy with a huge potential in Europe. But global markets are now flooded with cheaper Chinese electric cars. And their price is kept artificially low by huge state subsidies. So I can announce today that the Commission is launching an anti-subsidy investigation into electric vehicles coming from China.
What's even more intriguing in the world of Chinese electric vehicle manufacturers is the recent commentary from the head of NIO, William Li. He expressed hope for open-mindedness rather than isolationism among governments, particularly in light of the European Commission's anti-subsidy investigation into Chinese-made EVs. Li emphasized the importance of embracing competition for the betterment of users and global sustainable development, drawing on China's experience in developing new energy vehicles. Echoing Li's sentiments, NIO's president Qin Lihong highlighted the challenges faced by the company in Europe, emphasizing the need for a simplified market environment and positive guidance from governments and the private sector in the NEV sector. The European Commission's scrutiny of Chinese EVs comes amid a surge in their market share in Europe, prompting concerns about unfair competition and the role of state subsidies. Despite the Commission's stance, Li remains optimistic about NIO's prospects, projecting a quicker path to profitability than U.S. automaker Tesla. He aims for a sustainable gross margin of 20%, signaling confidence in the company's long-term viability. However, tensions between China and the EU have escalated, with China's ambassador to the EU criticizing the probe into Chinese EV manufacturers as unfair. The EU's moves have sparked retaliatory measures from China, including an anti-dumping probe into brandy sales. While both sides emphasize the importance of cooperation, differences in approach and policy priorities persist, particularly in areas like trade and investment. One contentious issue is the EU's exclusion of certain companies, such as Tesla, from its EV probe, which Fu Song, the Chinese ambassador, criticized as deliberate. This selective approach could exacerbate trade tensions and hinder progress towards mutually beneficial solutions. Additionally, discussions about imposing controls on technology transfers, notably in advanced semiconductor manufacturing, add another layer of complexity to EU-China relations. But hey, before we continue, we want to thank you for watching this far. So, amidst this, NIO finds itself in a predicament. Its stock has plummeted to below $6 per share, a stark contrast to the highs of the 2020 EV stocks craze when it soared above $60 per share. While some may view this as an opportunity to buy low, the reality suggests otherwise. The downturn in NIO's fortunes isn't merely a result of market fluctuations. Rather, it reflects deeper issues within the Chinese EV industry. The initial excitement surrounding EVs has waned, compounded by a sluggish recovery of the Chinese economy post-lockdowns. This has translated into softer demand for NIO's vehicles. Expectations of a late-year production and delivery surge failed to materialize fully, dealing a blow to investor confidence. Despite an uptick in deliveries, the numbers fell significantly short of projections, exacerbating concerns. Moreover, NIO's foray into a price war with other Chinese EV makers has further strained its financials, leading to increased losses and cash burn. Looking ahead, the outlook remains bleak. Competitor guidance from Tesla hints at prolonged sluggish growth in the EV market, prompting aggressive price-cutting measures. Moreover, NIO reported delivering 10,055 vehicles in January, an 18% increase from the previous year, but a significant decline of almost 44% from December. This drop is attributed to seasonality, as January includes the Lunar New Year holidays, resulting in a lean period for the automotive industry in China. Despite the year-over-year growth driven by higher sales of the updated ES6 SUV and year-end promotions, NIO's growth rates lag behind rivals like Li Auto and XPeng, who posted stronger monthly deliveries. NIO stock has witnessed a sharp decline of 90% from its peak of $50 in early January 2021 to around $6 currently, significantly underperforming the S&P 500 over the past 3 years. Concerns about global EV demand and price wars in the Chinese market have impacted NIO's performance, leading to price cuts and reduced gross margins. While the company faces challenges, there are positive developments in its battery technology and battery swapping partnerships. NIO's plans to enter the lower end of the market with new sub-brands and its relatively low valuation compared to other EV players like Tesla and Li Auto offer some optimism. Analysis of investor sentiment towards NIO stock, the impact of recent market performance, factors influencing its long-term growth prospects, and comparing its valuation with other EV players are crucial considerations for investors. So, will NIO's strategies and innovations lead to a recovery in its stock price, or will it continue to underperform in the coming months? Join the conversation in the comments below, and while you're at it, make sure to smash the like and subscribe buttons down below. Additionally, if you want to know more about NIO stock outlook, I highly recommend watching this amazing video. Simply click this video right here. Thank you for tuning in and stay tuned for more exciting content in the future.